Welcome to the latest episode of the Integrity365 Financial Insights Podcast, where today we will be discussing some of the speculation that surrounds what's been dubbed as the Halloween budget, Labour's first budget this autumn, which is being held on October the 30th. My name's Marcus Rea. I'm a Chartered Independent Financial Advisor of Integrity365. And today I'm joined by our MacDonald Partnership team and my fellow colleague, Bradley, who's based in Inverness, which has allowed us to expand our financial advisory network across Scotland. So, firstly, welcome to the podcast, Bradley.
Well, Marcus, thank you very much for the warm welcome and for having me along. There's certainly a lot to talk about with the speculation and concerns surrounding the upcoming budget, and maybe rightly so with the headlines that we've received so far with the £22 billion black hole that's been mentioned. It is true that Conservatives didn't leave the economy in a great position, but on the other hand, you have to presume that Labour were not completely blindsided by what they were inheriting. However, notwithstanding this, we've got another 5 years of the Labour government, so they perhaps want to get the more painful budget out of the way in the first instance, while the next general election is in the distant future. So, Marcus, have you had any concerns from your clients at all?
Well, many actually. Certainly, since obviously Labour coming into power, people have obviously expressed concern, especially with Labour announcing in the manifesto there'd be no increase into working taxes and so on. As you've rightly mentioned there, the discovery of this £22 billion black hole and the announcement of difficult decisions to come with the upcoming budget, as we said, on October the 30th. So many people are expressing concern and are worried as to what measures might come out of this budget, and primarily, I suppose, with my clients, and I'm sure you may be experiencing the same here, Bradley, it's focused on three main areas, those being pensions and the associated legislation attached with pensions, inheritance tax and capital gains tax. So I think they're the three main areas I'm being asked questions about. Are you finding the same?
Yeah, I completely echo that. I think the pension legislation is probably more so from the experiences that I've had so far, particularly surrounding the tax-free cash or the lump sum allowance that is now named. So on that, I think there's been some rumours that they're going to potentially reduce the lump sum allowance or potentially get rid of it in its entirety. I struggle to believe that they're going to get rid of it in its entirety, given that I think quite a lot of people in retirement will be heavily dependent on this. So, for example, for those of you who don't know, the personal pension, if you own a personal pension, 25% of that can be taken as tax-free cash, and the other 75% is taxable at your highest marginal rate of income tax. So I think, for example, someone might be heavily dependent on their tax-free cash in retirement. They might be looking to use all that lump sum to pay off their mortgage. So I think I can't see it being completely eradicated in its entirety, but I'm not sure what your views are on it, Marcus.
I'd like to agree with that. I would sincerely hope that the available tax-free element to the pensions aren't eradicated. I think many people rely on that and have been planning perhaps for years on releasing such sums to help clear mortgage debts or to invest elsewhere. And I think it would be extremely damaging actually for Labour to kind of get rid of that option that's available to people and that have been planning for many years to utilise. So I think it could be a bit of shooting themselves in the foot if they go there. I mean, obviously previously we had what was called the lifetime allowance in place. So the current maximum pension commencement lump sum is £268,275. Do I think, like you mentioned there, that they could reduce that? Yeah, who knows? They might reduce that figure to a maximum of 200,000 or even 100,000, they could even abolish it, as you mentioned. Now, I would like to hope, not only for my own future and many of my clients who I'm speaking to on a regular basis about this at the moment, that option will not disappear. However, people are obviously exploring whether they should take their tax-free cash now, prior to the budget coming in, because they're worried that that option may be completely removed in future. So I am being asked, should I take my tax-free cash now? And I guess that depends on each individual circumstances. But obviously, we can't advise in anticipation of what we might expect to come in the budget. We can only base our advice on what current legislation allows us to. So, we need to take into account the wider effects of, what might happen if you take your tax-free cash now, i.e., are you going to reinvest it? Have you utilised ISA allowances? By taking that tax-free cash sum, does it affect your wider inheritance tax planning if that's part of your financial planning? So there are a number of issues that just electing to take the tax-free cash now could affect your ongoing financial planning, and ultimately we don't know whether this legislation may change. So sometimes it's a case of kind of staying calm and waiting to see what happens, but also just trusting in your financial advisor and speaking with them just to put your mind at rest. I mean, are you finding the same, Bradley?
Yeah, I completely agree with what you're saying there, and just it's completely circumstantial as well. So, for example, if someone was needing that lump sum to make a large sort of capital expenditure in the not so distant future, it could be an opportunity for them to take that tax-free cash. Just with market volatility being one, and potentially some potential hostile legislation that comes into place in the autumn statement, which could negatively impact someone's overall financial planning. So I think there's different horses for courses, really. So it's very much one piece of advice might be applicable for one client and not so applicable for others. So it's very much, as you sort of said there, speak with your financial planner and potentially make sure that you're taking a holistic view on things.
Yeah, absolutely. And I mean, obviously, it's not just the pension commencement lump sum that's been kind of talked about in the press, and Labour are alluding to other changes that could come into play with pensions. I mean, they've obviously recently announced the kind of removal of the winter fuel payments, which has caused a little bit of a ripple, shall we say. But obviously the retention of the pension triple lock on state pensions, I think, as far as I've seen, is going to help compensate towards that and perhaps soften the blow, so to speak.
Yeah, and I think they have to be quite careful in that. You sort of said there that they're trying to stop people being so heavily dependent on state pension, and perhaps reducing the tax-free lump sum that you can get from your pension is maybe a deterrent not to put money into pension and not to save towards retirement. So I think that they have to be quite careful on that side of things.
Yeah, so I think perhaps, I mean, this is only a personal view, it's not gospel, but I think the more likely route is that, and perhaps a route that they may change more quickly, might be the changes to the pension tax relief regime. Obviously, people who are basic rate taxpayers receive basic rate tax relief of 20% on their contributions. Higher rate tax relief and additional rate taxpayers can receive 40 and 45 respectively. Now there is talk, as and this has been talked about in the past as well, Bradley, as I'm sure you're aware, and the introduction of a flat rate marginal rate of tax relief may be introduced. 30% being banded around. We don't know whether this may happen or not, but obviously if that comes into play, 30% tax relief for a basic rate taxpayer is beneficial. It's going to promote hopefully funding their own pensions and using those pension funds to supplement their future state pension income. It's obviously going to penalise on the flip side the higher rate taxpayers and additional rate taxpayers who are going to receive potentially lower rates of tax relief, just to help balance the division of wealth amongst pension savings. I mean, what are your thoughts on that, Bradley?
Yeah, I tend to agree. I think that is definitely an option that's been sort of touted about with regards to reducing the tax advantages for higher and additional rate taxpayers. Um, and I think again it sort of comes down to whether or not they will introduce this and if it is a potential option. Another thing that's been mentioned, or option that's been mentioned, is that they could potentially raise the minimum pension age. So, for example, at the minute, you need to be age 57 to potentially reach to access your pension. I think that's going to raise to 58, and that there could be an option where they raise it to age 60 as well. But that in itself will encourage people to continue working a little bit longer, perhaps, which we could potentially reduce the deficit as they'll still be paying income tax on that. But I think there's a lot on the horizon on that front.
Yeah, I agree. And I mean, one of the other wider issues, I think, was obviously with the Conservative government abolishing in what was a surprise move at the time, the abolition of the lifetime allowance, was whether there may be talk of a reintroduction of the lifetime allowance in some capacity. It appears Keir Starmer has previously ruled out such a move, and I understand HMRC are kind of working in the background to ensure the kind of final pieces of that puzzle are put together so that abolition can go through efficiently as planned. But the wider context of pensions as well is whether the Labour government will bring in pensions and make them subject to the inheritance tax regime. Now, many of my clients do use pensions as an inheritance tax planning tool and intergenerational wealth planning tool. So personally, I think this would cause some concern amongst a wide part of the population who are funding their pensions.
Just sort of touching on the inheritance tax side of things, as you sort of mentioned there, that the inheritance tax bills, or more people are paying inheritance tax, just given that inflation has increased over the last year, the number of years, and the nil rate ban. So each individual has a £325,000 nil rate band. And if they were to pass away, anything over and above that is subject to inheritance tax. So that £325,000 hasn't changed since 2009. So the more and more people are paying inheritance tax. We're not entirely sure where they could go with that. I think that might cause a little bit of concern for individuals if that nil rate band does reduce, just given that it's not increased at all since 2009.
Yeah, I agree. And obviously there's also the additional residence nil rate band of £175,000 in addition to the nil rate band, which is obviously applicable to estates with £2 million. Is tapered off for every £2 by a pound over that value. But obviously the residence nil rate band is only applicable if you are leaving your property to a direct descendant. I mean, I've read varying news articles that are suggesting that perhaps they completely scrap the residence nil rate band, which will obviously bring more estates into having to pay more inheritance tax at the rate of 40%. I completely agree. They have obviously frozen the nil rate band. Who's to say they might not reduce that and try and generate more inheritance tax receipts? Yeah. And we just don't know at this point. I think one of the wider issues is, as I mentioned there, is Labour are contemplating making pensions subject to IHT in the event of death, which, as I alluded to earlier, would cause no end of problems. But additionally to that, I think the focus on inheritance tax is the potential look at agricultural land, cultural relief, as well as business relief, which again is raising serious concern amongst my clients.
Another option that could be sort of mentioned or has been mentioned is that they could increase the 7-year gift rule. So at the moment, if you're estate is over the inheritance tax nil rate bands, and there is a portion of your estate that is liable to inheritance tax, you can make a gift to anyone, whether that be your friends or family or your direct descendants. Once the gift is made, there is a 7-year clock that starts, and then after the 7 years, then that amount falls out with your estate for inheritance tax purposes. So I have sort of read up on this, and there's a potential that they could increase that, or potentially just get rid of the gifting rules, which would potentially be an option.
Yeah, I mean, what you're referring to there is obviously something that some people may have heard of, what's called a potentially exempt transfer, or PET for short. Yeah, I too have read, varying reports that could lead to the increase of the 7-year rule, which would obviously make it more difficult for people to gift assets tax efficiently from an IHT planning point of view. It would give the government a longer scope to be able to tax people under the inheritance tax rules after they've made that gift. So that certainly could be something that comes into play. I think other tweaks that, again, that could be played with is, do they play around with other parts of gifting rules? Are they going to play around with the annual exemption in relation to being able to make gifts, and the gift allowances for wedding gifts, and so on and so forth. So there's quite a lot of scope in that area of inheritance tax planning that I think Labour could potentially change. I think regardless of what they do, some people are going to be deeply upset. It's the case of those who have and those who have not, and I think that's where Labour are rightly, trying to address the balance. So that's kind of pensions and inheritance tax plannings we've discussed so far, Bradley. So I guess the other big area that many of my clients are concerned, we have clients who have invested portfolios. We have clients who might be fortunate enough to have second properties. Not everybody's in that situation, but the tax regime that many people might get caught out with this budget is the potential changes to capital gains tax.
Absolutely. So the Labour government have confirmed that working taxes are not going to be sort of reviewed. So that sort of includes income tax, probably savings and interest rate, dividends, potentially corporation tax and VAT. So I think that only kind of leaves capital gains tax and inheritance tax as well. So on capital gains tax at the moment, I think you're right in that there isn't really much wiggle room for reducing the annual exemption. So previously, at its highest, you would have a capital gains tax exemption of £12,300. So if you made or disposed of an asset and the gain was less than £12,300 in an annual tax year, then there'd be no capital gains tax liable. However, that has since reduced to £3,000 per individual. So I don't think I think there wouldn't be much impact on the deficit if they were to reduce the annual exemption. So my sort of thought process is that they could potentially increase the tax rate. So at the moment, it is 10% for, in some instances, for basic rate payers, and 20% for higher and additional rate taxpayers. So there is talk of it potentially being increased in line with the income tax rates, but there's still a lot to remain to be seen on that.
Yeah, so yeah, they're talking about potentially aligning the tax rates with that of income tax, which will obviously generate more in terms of tax receipts from a CGT perspective for the government, but I think it will also help to simplify the tax understanding of the wider populace as well, because the rates will be aligned for both capital gains tax and income tax rates. So I can definitely see that happening at some point. I concur with you. I don't think there's much wriggle room for the capital gains tax allowances, but wider scope of capital gains tax as well. I think the potential changes that we're talking about here has led to kind of some people who might have second properties and so on. It's affecting the kind of share prices of the housing companies out there at the moment. You know, people are panicking, which in turn might actually generate some very healthy short-term capital gains tax receipts for the government. And obviously there was another kind of announcement, which again, I think Sir Keir Starmer's potentially ruled out, was, you know, there were murmurs of your main residents potentially falling foul of CGT duty should you sell your main residence. Now, I, for one, am hoping again that will be, that they'll see sense and that might not come into fruition.
Yeah, absolutely. Because I think if we'd discourage the housing market as well, because you still need to pay your stamp duty and land tax as well. So, or your so I think you would get taxed on disposal and then taxed on purchasing. So I think that would encourage quite a lot of people moving houses as well. So I think they could potentially target people with second properties, as you've sort of said. I think with people struggling to get onto the property ladder all across the country. We've seen it even up here in the Highlands of Scotland with people buying properties or short-term lets for individuals, or so as an additional source of income. So I think that's discouraged or made it a little bit more difficult for people to get onto the property market. So I think that's an area which could be targeted as well.
Yeah, I agree. Now, as those of you who are listening to this podcast, I think you can probably agree we've covered quite a lot so far today. Obviously, there are wider parts of the budget which may impact you too, but these are the main areas that we've discussed today that, you know, Bradley and I in front of our clients are hearing most of from a day-to-day basis. So all I would say is, obviously, if you do have any questions off the back of this podcast or in general, please do contact your Integrity365 or MacDonald Partnership advisor. So, for example, contact myself, Marcus, or Bradley, and please do discuss your concerns if you have any, and we'll obviously help make sure that your financial planning remains on track. Please do stay tuned, because as the budget approaches on October the 30th, we will continue to provide updates where we can and try and put your minds at rest. So for further insights from our team of advisors at Integrity365 and MacDonald Partnership, please do tune in to our further episodes on YouTube and Spotify. But for now, what I'd like to say is thank you for joining us, and thank you to Bradley for taking your time out today to go through this podcast.
Thanks so much for your time, Marcus. I really enjoyed that.